Hello everybody, this is Chris Karam, Chief Investment Officer with Finspire. Today I'm joined by Jason Brooks, Senior Vice President of Wealth Management here at the office. And we're coming to you live from our newer podcast studios here, so you see some interesting designs behind us. What we want to do today is actually April 23rd, so we wanted to give you a recap of what's happened in the markets in the last few weeks, certainly post trade announcements, trade and tariff announcements. However, what we also want to do is get an applicable relationship of how to handle those market fluctuations that we've had over the last few weeks, which we haven't had, by the way, in a couple years, and what that means to your portfolio from a strategic financial planning point of view. And so I've invited Jason here to join us today, and we're going to do a quick recap of where the markets are, but then also shift the focus into not only portfolio management, but how this impacts financial plans and some of the strategies that can be applied along the way. Okay, as usual, we're going to offer you some information here about what happened in the markets, certainly since the beginning of April, but then we're also going to add in our opinions along the way about what to do from a strategic planning perspective. So let's get right to it. Jason, the markets today, if you see here over the last few months, have been dramatically different than they have been the last couple of years. We've noted this in our Focus on the Markets videos that come out quarterly. You can get those right off of our website. These slides that you see here are actually on the top of our website. You can get them updated daily off of our site, as well as scroll down and you'll be able to see our quarterly market videos. One of the things that we usually highlight is just what's happening relative to the S&P 500 in the U.S. equity market. And you can see so far this year, much different than it has been the last couple. So the last 2 years, 2023, 2024, plus 25 or greater percentage points return on the S&P 500. And you can see some of the laggards of other asset classes trailing, especially the last couple years, up until this year. So the first, call it 3 months and about 20 days or so, international stocks are leading the way. Commodities are up again as a whole. Fixed income bonds are up and actually contributing to portfolios this year, where it was a bigger challenge the last couple of years to see fixed income contributing to total return. Even emerging market stocks are about flat for the year to date. And you can see their small companies down about 15%, S&P off just shy of 10% as it stands close of business yesterday. Yesterday was a sort of a big movement day on the markets. We've had a lot of big swings in the markets. Volatility is elevated. And that's really where the markets are today. So that's actually an improvement from where they were about a week ago. But one of the key questions here, of course, with the tariffs is what is this going to mean from an economic perspective? In the quarterly video, we get into things like, is this going to lead to a recession? And the leading economic indicators, although they've been improving, have still been showing signs of weakness. However, what we have seen is pretty strong employment figures so far. We'll see if that continues with the tariff announcements with the April data coming out next week. I want to get into, however, is this just a reflection on what was higher equity valuations and prices going into the year? And this is one of our favorite charts when we look at just how expensive the market is relative to the earnings generated from the S&P 500 companies. With the S&P 500 moving in this jagged line, the earnings in the blue mountain. Anytime the jagged line gets closer to the top of the peak or of the blue mountain earnings backdrop, then markets tend to retreat, and we got that this time here. You can see a big retreat here recently. Now, of course, were the tariffs a catalyst or just reflecting on high valuations as a catalyst to take the market down? Probably, but as we know, the tariffs became more of the central part of the story, not so much on valuations. Bond markets have been all over the place in the month of April. With the 10-year yield settling in at the close of business yesterday about 10.4%. And that's slightly above where it was to end the quarter. So the bond market's been, as much as the equity market's been uncertain, the bond market's been uncertain. But total returns, as we noted year to date, are still slightly positive in fixed income, which has been really helpful to portfolios to control the downside of portfolios. So with that being said, I want to come back to this diversification concept. all of this, Jason, given we looked at here what it really is, the asset side of the equation, the asset management side of the equation, the portfolio management side of the equation. What are your conversations been with clients like this month, and what are some of the things that you're telling them strategically?
Sure. Well, the first thing that I'm trying to establish with clients is to basically, especially for the ones that are concerned, is just to kind of step back, take a deep breath, and understand that, we have built portfolios to some degree to handle periods such as this. Mm-hmm. And the diversification has actually been a key theme because, as you noted here, it's not like everything is going down. Mm-hmm. So when you have, like our portfolios have a decent amount of equities allocated overseas, and we have a decent amount of fixed income depending on, the age and time frame of the client. Mm-hmm. But what I found is when they ask how they're doing better than they thought they were. And I would attribute that to diversification. So the first thing is to tell them, okay, it's not as bad as you think. Take a deep breath, and then talk about kind of putting this all in historical context as far as just the fact that, every year typically you get on average a 13.5% pullback in the market. Mm-hmm. at some point during the year, an intra-year pullback. I haven't seen that for a couple of years, so right. People's memories kind of fade on that, but it is normal. And at one point we were probably a little beyond that, but now I think we're a little below that, as you can see here. But either way, knowing that this isn't completely out of the ordinary and this happens often, that helps them. So then we talk about as far as just what's going on today and how the markets are so fluid. A lot of it is headline driven, and that there can be volatility on the downside, but there can be also volatility on the upside. Right. So, the concern there being that, okay, if you were to potentially want to go more conservative here because you're worried, you could miss out on some really good upside days. And historically, putting that into context, most of the best days in history occur really close to the really bad days. Mm-hmm. So you want to be careful because, you pull out, you miss those up days, then you're really kind of behind the eight ball. So try to just keep them from doing something that's going to hurt them long term. And then just talking about typically what happens going forward. We can discuss about what has occurred as far as the drawdown, but then it's what usually happens the next 12 months after a major drawdown. And historically, the forward-looking returns for 12 months, as you know, are very healthy. On average, when you get a big drawdown like this, the next 12 months could be upwards of 20% forward return. So again, you don't want to get out and miss those things. So once you kind of take down the temperature and establish, okay, I feel a little bit better now, but what should we do strategically? Mm-hmm. From, do we just sit here? Or are there opportunities here? And that's a great part of the conversation, because there are, mm-hmm. Opportunities. And usually the first one is just say, okay, well, let's look at your asset allocation relative to where we want you to be or where we targeted you to be based on your risk tolerance and your time frame, and see if you're out of whack materially. Mm-hmm. When you have big dislocations in the market, the stock market drops a lot. You might have been 60-40 going into this thing, and now you're 55-45. So in that case, we need to rebalance you back, and essentially what we're doing there is we're selling bonds and buying stocks. Yeah, this is one of the sharpest declines that we've seen really since, in its expeditious manner, really since COVID, right, back in 2020. Yeah. And the concept of rebalancing can be hugely beneficial at a time like this, because you effectively are selling some things that have done well or held up well in this down market, and buying into things that have sold off but still look awfully appealing. So case in point, maybe some of the S&P 500 companies that maybe we were a little shy about going into the year, with that sometimes phrased as the Magnificent Seven stocks of the largest especially the largest technology companies in the marketplace. Perhaps there's an opportunity today. Absolutely. And it's not only, if you're looking at your diversification chart, you would think, okay, you sell a little international, sell a little fixed income, but you also see a big discrepancy between growth and value stocks this year. Growth being the Magnificent Seven and other tech names, but some of the more blue chip value names have held up relatively well.
Right.
So, again, good opportunity, maybe take a little over there and move it to the growth side. So certainly rebalancing opportunities. So that would be a big one. And again, that's not market timing.
Right.
People, you have to make sure you understand we're not market timers. We're not trying to guess that, okay, growth is going to be better or now the U.S. is going to be better than international. We're just saying let's get back into balance of where we should be.
Yeah, let's shift the conversation a little bit. So there's definitely some portfolio management things that can be done, whether it's rebalancing a portfolio back to a target after the market makes adjustments for us, especially in rapid fashion. There are also ways to play some offense, if you will, from a financial planning perspective. You've written some tremendous articles that are available on our website on just how to financially plan for certain events, especially given your background as a CPA and maybe even things through a tax lens. What are some things that people are doing today to, in fact, take advantage of a lower equity market and valuation?
Sure. I would say the number one thing that we're doing for clients that have assets in taxable accounts, non-retirement accounts, is we're looking for opportunities to harvest losses. Mm-hmm. And essentially what that means is, selling something that's trading down, booking that loss, and then taking those proceeds and immediately turning around and buying something else. So we're not market timing. We're not really going to be out of the market. We're just basically booking losses because, as you know, you're allowed to net your losses against your gains. So anytime you could put some losses in the bank, it's a good thing because especially, we assume in the future there will be gains. So it's nice to have those losses now to offset those. And if you were to go net negative in a given year, you could actually carry forward those losses into the future. Yep. So that's like my favorite one at times like this. Again, you have to have a taxable account. Another thing that's important too, if you hadn't done this already, or if a client says to you, hey, I'm going to need some money in the near future, this is a time to start, raising some cash and putting it on the sidelines. A lot of times you'll get a heads up on that, so that would have been something that you already did, but sometimes clients will throw it on you kind of in the midst of the craziness.
Yeah,
and then,
life happens, right? Yeah, surprises needed.
Right. Yeah. And then you basically, now I have a mission to say, okay, as we get some of these up days, I'm going to start raising some cash. So that's, I don't know if that's an opportunity, but it's just something to be aware of. And typically we do keep a little bit of cash on hand for people, but again, life happens and things come up, and you want to make sure that, you're not raising cash in the midst of a majorly down market, because then you're selling stocks at a loss. So in other words,
don't sell the things that have gone down in value. Sell from the areas that have held up or even improved this year, if a situation like that arises.
Exactly. If somebody needs money right now, I'm not selling it from the S&P. I'm selling it from bonds or international. The other thing I would say some people look at doing, especially if they know they're going to do a Roth conversion this year, is converting now versus later. Typically when we do Roth conversions for people, and like you said, I've written articles about it, it's usually lower income tax bracket taxpayers that have some room to absorb some additional income at a lower rate. Typically when we do that, it's more towards the end of the year, mostly because we want to see what their income is, and you need some time. But if you know pretty much confidently that their income is going to be similar to last year, and they did a $50,000 Roth conversion last year, so they're probably going to do it this year, it makes sense to do it now versus later, because you're taking out the same money. Now it's, say, 15% lower. That gives you more room to grow tax-free in a Roth.
Less of a tax liability at the end of the day.
It's you're still taking out the same dollars, so you're still getting the same amount of a 1099, but down the road you're appreciating more tax-free, and you're also lowering your RMD by taking money out. So I would say those are the main things. But yeah, there's definitely some things that can be done proactively, but again, first you got to get your clients on board, because if they make a mistake and pull out of the market, they're taking themselves off of a path that is going to be hard to get back on.
Yeah, that's one thing that's tough to recover from, right? Making a timing decision that doesn't work out as you intended. So that's really a good summary here. We want to play defense with good diversification, especially when the market is down. But we also want to play offense when it comes to financial planning and tax strategies that might be advantageous for you individually. Please feel free to follow us on our YouTube channel, the Finspire YouTube channel, for more content like this. And thanks for joining us and listening today, and hope to talk to you soon.
Thank you.